All right, welcome back to episode 15 of the More Doors podcast. Today, we're talking about how the evolution of the financial models have changed. You're going to want to tune into this one. We're going to get started right now. All right, welcome back. Episode 15. Today, we're going to be talking about how the financial modeling has changed now that we're really starting to get some understanding of what this market is. So we're going to dive a little bit deeper into what that looks like today. But look, today's show is brought to you by our favorite sponsors, Deep Blue Capital.
DeepBlueRE.com.
Yeah, DeepBlueRE.com. If you're needing to, look, you got some money, right? Maybe you got it just sitting there making 5%.
Yeah.
But you got to pay taxes on that, right? They don't talk about that. Like, oh, I got my money in this money market account.
Taxes are yucky.
It's making 4 point something, 5. Maybe you're getting 6 if you're with like these online shady lenders, banks. You don't know what they're doing with that money. Could be dirty.
They're probably loaning it out at 8.5%, 9%.
Exactly. That's exactly.
Why not earn that on your own?
Yeah, exactly what you're doing. So why don't you take that money and see what Deep Blue Capital is doing with it, right? We can show you how, with our strategies, how you can get better tax advantages, better tax strategies.
Better returns.
Better returns. Everyone wants better returns. Just go to deepbluere.com, sign up, get on the newsletter, see the assets that we've already purchased, stabilized, and hopefully you'll see the ones that we sell off pretty soon. So
I'm gonna add a new feature to the website. I've been thinking about this a lot, so that we can pump it on the podcast. Do you guys remember when you're in like middle school, there was like candystand.com, which was just a bunch of games. You'd play like all the games.
No, Buchowski was like, there was no
internet when I was in school.
Jesse, can you pull up candystand.com? See if it's still there.
What's going to come up?
This is very relatable. I'm saying it was like, because you guys have to know what I'm talking about, and we'll like splice this in the show. I don't know if it's still there. Yeah, it was stuff like this. It's like you could play putt-putt or field goal challenge or basketball shoot-off. You see what I'm saying? It was stuff like this. I'm going to start doing a whole bunch of just games on our website as well. So it's like, do you want better returns, tax advantages, want to try to kick a 65-yard field goal?
Go to deepbluere.com. Yeah.
People get a lot more attention that way.
Maybe so. Like, people love to play games. So just go to deepbluere.com.
We just got blocked, by the way.
Yeah. So, all right, let's break down the evolution of the financial model has really just kind of adapted, evolved, and it's definitely changing from what the last 3 years have looked like.
Yeah. Well, I would say to even start, right, 3 years ago, man, is it already 2023?
Almost 2024, bro. There's less than 100 days left.
Yeah. So maybe start by like 3 years ago, financial modeling and just underwriting and assumptions changed drastically in a very short period of time from what was kind of normal for decades.
Actually, let's go back because it's what we're September.
Yeah,
September. Jeez, you don't know that we're in 23. I don't know what month we're in. So September 23, what is that? We're 6 months into the pandemic.
Of 2020?
Yeah, of 2020. Mm-hmm. During that time, you were still having, in a lot of counties, a lot of states, you were having the eviction bans that were happening. Mm-hmm. So, but you were also, I think the stimulus checks were starting to roll out then, if I remember correctly.
Yeah.
I think they came out towards that last half of 2020, if I remember.
I went to Cancun around that time.
Way to rub that in people's faces.
Yeah. No. One, if you're ever going to go on vacation.
Did you use your stimulus check to go?
And that's what I was about to say is one, it was mad cheap because they were just trying to fill beds any way they could. And it was very crowded because I think that a lot of people who didn't really need the money got that stimulus check and were like, we're just going for the weekend. Yeah. It was like $700 for 2 people for 4 days. Yeah.
Sounds very windy in here all of a sudden.
Is that just in our headphones? Yeah, sometimes that happens. Okay. That's how you know a UFO is flying overhead.
Yeah.
Okay.
So if we go back to 2020, you're underwriting probably to have eventually some evictions come through. Mm-hmm. Because when did you, during that time, did you buy, you acquired some assets during that time?
Yeah. We acquired before and during.
Before and during. So when you were underwriting back then, what were you taking into account? What was your vacancy model?
We always underwrite to like 7 or 8% vacancy between physical and economic.
Even then?
Even then. Yeah.
Okay. Did you have, at that time, because we were, in the middle of that, we had broken ground to build 89 townhouses, which was a whole shit show at that time, just because the city wasn't coming out to issue permits, even though it was all outside. They wouldn't walk out there.
You can't come out to this piece of land.
Yeah.
Because I have my mask on.
Right.
Yes.
You
Yeah.
know,
So,
and it's daytime.
with no buildings that even exist.
So we were just starting to break the ground on the 89 townhouses. So we weren't acquiring anything other than the building of that and then the assisted living facility. So, we had already owned some other assets. And I do know that we evicted some people, not on financial reasons, but because we found like weed in their apartment.
Because they were anti-vaxxers.
Yeah, we don't talk about
I'm
that.
just
you
kidding.
can't
I'm
talk
just
about
trying to
that.
draw you off sides.
Yeah, thanks. Yeah, we're not allowed to talk about that.
But this coming from the guy that talked about money laundering with the attorneys on the podcast.
Yeah, well, look, you got to keep people honest.
Exactly. It's a test. It's a test. But, for then what we were really looking at, we were definitely concerned about, the assets that we were holding, about evictions going up. How are we going to pay? Are we going to be able to take loan modifications and everything else like that? So you were still, you didn't have underwrite for increase in vacancy or increase evictions?
No, and I'll tell you why. Because when we first started, we were really looking to scale the business in as regular and low risk environment as possible. So when COVID hit, we were almost 100% Section 8.
Yeah.
Gotcha.
Okay, so we had guaranteed rent on the first, whether they had their job or not, right? We always typically got the 100% voucher from the state. And the only eviction that we had was in October of 2020 when some lady's boyfriend kicked the door in and demolished the apartment, and we kicked her out for vandalism. And that was a whole thing. But we had a couple of folks that were market tenants and paying, but there were day laborers, there were real working class apartment, and those folks never lost their job, and they were just thankful to have a clean place to stay.
Right. Yeah, interesting. Okay. Yeah, because I owned some Section 8 that we just dispoed on, but I didn't think about that just because normally on the Section 8 it's just,
I know it's not your forte, it's not a lot of people's forte, but like to me, to Mike and I, when we were scaling up the business, we had a finite amount of time to spend on dealing with tenants and property management and all that kind of stuff. And these folks just came in. If you find the right ones, they're great.
I do believe that it's also, if you're going to go and build a Section 8 portfolio, I think what matters most is really the location.
Yeah.
Like where my location was, it looked very crime-ridden, and there was nothing I could do to clean that area up.
Yeah, you can't move the house.
No,
right.
And so it would only attract a certain, because I didn't own the entire street or the block, and the rest of the area. So there was a mixture, I think, of two or three other investors, really three other investors over that own the rest of it, and they're just. The amount of cleanup it would have taken. The city also wasn't really keen on they weren't really Section 8, friendly, in my opinion. And because the way they wanted us to run this was like a normal rental. And, it's a little bit different. That's a different type of clientele, different type of asset. And it just takes a different management structure.
Totally.
And so like where yours is in a great location. I also think it attracts a different quality of Section 8, tenants.
It does. And it has, and it's worked out really well. But I think it's also, it's got a lot to do with the screening. We would put a listing up on gosection8.com and we'd get 100 people that raised their hand. And, we would follow equal and uniform housing and Fair Housing Act and all that sort of stuff. But you take a single mom who's on the program and has 2 young kids, and they're already in like Oak Cliff or South Dallas, and they're worried about how their kids are going to get home from school, and you put them on a tree-lined street in Richardson, and they're like, I can't mess this up.
Yeah.
Right? And we would get a call every 6 months when the microwave would break or the fridge wouldn't work. But I can tell you that we've had very few instances. We had one lady who was on the program, and like kids were drawn on the wall and stuff when they left, so we had to put some money back. But we've had people with us 5-6 years.
Yeah.
I think it's just, we talk about common sense investing a lot. Solving problems is always a good investment thesis, and having Section 8 that is in an area where you have the ability to really attract a quality tenant.
Yeah.
That's providing a solution. That's providing an affordable housing solution.
Yeah, we could spend we can do a whole episode on Section 8, but we would look at the zip codes. We looked for the highest voucher amount in the zip codes. And then even within that, there's these Walker vouchers, which are like super high opportunity vouchers that would pay 20% over the actual like voucher amount from DHA. We were unfortunately never able to get one of those properties, but if we would look for them.
Yeah.
And, I mean, they were great. They were really very, very helpful for us to get our muscle memory and build our systems and processes and tenant profiles and stuff. And I don't think we have much in the way of Section 8 now, but it was great, and it got us through COVID, right? Which is where I think we started this story.
Well, and really how you modeled back then versus now.
Yeah,
right.
And honestly, our model at that point, Mike built it, right? We were nowhere near as sophisticated. Mike's a really smart guy, don't get me wrong, but we were nowhere near as sophisticated as the stuff that we use now.
Yeah.
100%.
And so what do you believe now has changed? And because obviously we said the evolution of the financial modeling.
Yeah.
What do you see that now you're changing in your underwriting?
Yeah, it's a good question.
That's why I asked it.
Yeah,
I ask great questions.
I see that. I think you got to do a couple things. One is exit cap, rent growth, expenses, right? And cost of funds, right?
Yeah.
I think you really got to spend a lot of time on that. And then I guess fifth is comps, right?
Yeah.
So when we were seeing deals 2 years ago when the market was super hot, I still actually see it today where you see a deal and the OM comes along and says, Yardi says 12% rent growth in the last 12 months.
Yes.
You cannot, I repeat, cannot assume that 12% rent growth is going to happen again.
No.
Right?
Right.
And I think sometimes people get caught up in the kind of the commercial effect of reading what's on the front page of the OM and assuming that type of stuff is going to continue. So we use data from CoStar. We use data from RealPage. Sometimes it conflicts, and sometimes we slice down the middle.
Well, I think you have to, especially on the rent growth, because I think that's what we've seen, and as we've talked to, as many brokers as we're talking to now, is that, number one, what we have tried to model within the Deep Blue Capital side of things is, and I know Brian asked this question a lot, what happens if you change the underwriting to zero rent growth and over 2 to 3 years?
Right.
What does that look like?
And I don't ask that necessarily because we debate this, and this is what I love about this partnership is we challenge one another and we debate this back and forth a ton, and that's where I think a lot of great ideas come from in investment strategies. I guess my thesis on asking that if it goes to 0% is like when you're looking for a deal and you're looking to invest in an asset and add value, it makes sense in my mind to always underwrite for the variables not that you can control but that you can best predict, meaning there are so many things. If you've never underwritten in a multifamily deal, it is just a collision of line items that you are trying to discern what it's going to be for the next 5 to 10 years. And when we talk about moving targets, things like taxes, insurance, things that have to do not even with just the real estate market, but politics and things like that. There's already so much that we need to work really, really, really hard to dial in. I guess my thesis in asking that is if we're already working our asses off to dial in variables that you have to have a pretty high intellect to have a good gauge on, does it make sense to also make a deal work based on rent growth that we've seen over the last few years can be all over the place in the blink of an eye, right? Like one world event or one whatever, right? One or the Fed rate or whatever, right? All of those things have a substantial and material effect on rent growth one way or the other. I think that one of our guests, Elijah, last week had said the same thing. It's like, if it's a deal, it should be a deal whether or not you increase rents, and then increasing rents makes it an even better deal, but you should underwrite it, at least in this particular environment where rent growth has been so high for the last few years, underwrite it like there's no rent growth and make it a deal. And then when rent growth continues or the market improves or whatever, now you've come through in a big way. So I that's why I asked that is, how do we control just the things that we know that we have the most control over?
Yeah. I think the concept of no rent growth or zero rent growth it needs to be taken in context. So if you're looking at a value add opportunity and your goal, or you're going to buy a property that has $900 average rent per unit, and you're going to drive rents to $1,150 because of your CapEx plan, right? You can say it's zero rent growth as long as you achieve your pro forma rents, right?
Yes.
Right? So it's not necessarily zero organic rent growth. It's actually forced appreciation by almost 30%. Right? But it's justified because you're making the CapEx investments to get you there. Now, I think personally that zero rent growth is a very, I don't want to say dangerous, but very conservative, right? And I think there's a dichotomy between how conservative you want to be on the underwriting and how many deals you want to acquire.
Sure.
Right? And I think when we're looking at data from CoStar and we're looking at data from RealPage, and we have the two biggest data providers out there for multifamily industry, and they say rent growth in a certain area is going to be X. I get being conservative, but if we're going to go in at zero or 25% of X, right? Like, why do we think we're outsmarting them?
Right.
And I think that's a conversation that we deliberate on and for healthy reasons, right? Yeah. We want to get into good deals, but the other side is an economic thing, right? So if you have average rents of $1,160. They're probably not moving if you raise it to $1,195 in year two.
Yeah.
And that's a 3% rent increase.
Yeah, some of this is just knowing your product and your market. Yeah.
Right? And I think you've got to think about yourself in the eyes of a consumer. Even if it's a competitive market, you're probably not going to lose a whole lot of people on a renewal for $25 or $30 a month.
No.
Yeah.
No, because if you think about it, that's $30 a month. That's $360 a year. It's going to cost them more money to move.
It's going to cost them that to just rent the U-Haul to move.
I think absolutely. Those are the real conversations. Reed Bennett, who's going to be on the show pretty soon, made a post about this on LinkedIn, I think yesterday, and I was kind of just reading the comments. And what you just said makes a lot of sense, because I also believe that while you have to be highly analytical to do good deals, you got to know what you're doing, and there are a lot of variables. You can also just massively overanalyze. You can overanalyze yourself out of making common sense decisions.
Who are you?
I know.
What have you done with Brian?
You know what I'm saying? If you know your market well.
Are we recording this?
If you know your market well, I think you can make a lot of common sense decisions. One of them being, you just made a great example between like the difference between 1160 and 1195. That's, I think, one of the smartest things that an investor can do that gets lost on most people is you get so involved in the math that you don't realize some of the kind of emotional element. When you do any sort of rent push and you stay under the next century line, you are exponentially more likely to have tenant retention.
Exactly.
The difference between $11.95 and $12.05 is $10, but it is monumental in the eyes of the consumer.
Yeah.
Right? So that there's some common sense stuff there.
They're just going to start looking around, right? You don't want them to start looking in comparison shopping.
Right.
Yes.
And maybe over here it's $1,200, but they're offering 2 months free rent. And they're giving free coffee every morning. And
sure.
They're like, I love coffee, so I'm willing to just go and pack all my stuff up.
Are you a coffee guy?
Love coffee.
Me too.
I drink probably 7 to 10 cups a day.
Me too.
No, you guys.
I am completely jammed up on coffee most of the time.
I am too.
I think someone this morning felt the wrath of being over caffeinated.
I hope they're not. I hope they don't watch this episode. So so that's one factor, right? We've got rent growth or just rent projections. The other thing is as the financial and modeling has evolved or changing, is when we talk about expenses, right? And so, as we've gone through that, even with our own asset, of just kind of seeing some, where some things where we didn't account for, but we counted for, we were over conservative over here, but not over here. Do we start to really see certain expenses start coming down? Like, CapEx budgeting technically should be coming down.
Could be. Yeah, should be. Absolutely.
Should be.
Yeah.
It means materials get more affordable and
more people looking for work.
People looking for work. Yeah, labor is a little tight right there.
Look, the last 2 years, the labor, just demand in labor, it was outrageous.
Yeah.
Not to include if you were needing certain material.
Right.
When we were building the townhouses, our initial lumber bid was $500,000.
Wow.
Right before COVID. This was February or beginning of March. When we locked in, 1.9. Whoa. For lumber.
That'll blow
1.9. Yeah, it hurt the builder.
Yes.
Hurt the builder on that one.
Yeah.
And so when you kind of factor that in, a lot of people are probably still underwriting at maybe higher expenses. When it comes to the cost of rehabbing and your CapEx budget, the turns. And if you don't have a good control on that, just your make readies can kill a deal.
Totally.
Yeah, I don't think. I mean, we've done that with just stuff like turns have cost more than we had
I got
thought.
a $3,500 turn invoice the other day.
Yeah,
crazy.
I mean that type of stuff. Yeah, you have to account for it. And here's the thing, is. Again, this comes back to the common sense aspect of it. Is there's definitely reason for a lot of expenses to come down, right? When the labor market expands a little bit and there's more people looking for work, then your maintenance costs should hopefully come down, right? Stuff like that, because there's a bigger pool of people looking to do that type of work. You would think, and this is a mistake that I think some people make in their underwriting, you would think that other expenses start to normalize as the economy starts to stabilize as well, but they tend to take a long time to. Things like insurance, you think like it should come back down, even though it's gone up 10 or 15%.
I think the government steps in on that in a year or two.
You think so?
They have to.
And that might be the only way is government intervention, because for some reason, everybody raises prices in times of inflation, but then when inflation comes down, magically,
nothing changes.
Yeah. Somehow those prices don't come back down.
Well, I know, like in Florida, they do have some government issue, like government-backed insurance. I was talking to I own a couple storage facilities out there, and we really got to spend some CapEx on them. And I was talking about insurance, and there's only 2 insurance providers. And one of them in Florida, and one of them, I can't remember the name of it, is really state funded, is what he told me.
Really?
Yeah. And so, do we see that in Texas? Maybe
on the coast.
These are on the coast. Yeah, I own some in Tampa. I think they're all in Tampa.
No, I just mean even in Texas, you might start to see it.
Oh, yeah. I thought you were still talking about me.
No,
yeah,
not all the time. Not all the time.
So what do you think that would look like?
I have no idea. I'm not that smart.
It just can't continue to increase at 10 to 15% every year.
No, it can't. It can't.
And look, it can because
the tenant's going to pay for it, right? They're going to squeeze the landlords to a point where. They're going to start taking it out on the tenants.
Well, it's a couple of things, and I did a news segment about this earlier this year. It was not just about insurance, about property taxes.
Yeah,
and that was one of my main arguments is that as multifamily investors and holders of we create housing.
Yeah,
for the local citizens, and you cannot have your property taxes go up 40 to 41% over 1 year, without talking about it,
right.
Without having some plan in place.
Well, I mean, one of a few things would happen. Either you pass that on to the tenant in the form of higher rent. So we actually talked about the numbers that on your deal that it would take to actually offset that, and it was ridiculous.
Yes.
Your tenants wouldn't be able to afford it, or you have to make up those dollars somewhere. And so where do you make those up? I mean,
covered parking.
Yeah, well, yeah, right. Or
that's the broker's response.
Yeah, that's always the broker's.
Add some covered parking here,
and an internet package, and you're good to go. Right?
Smart tech.
Realistically, the way this plays out is it costs a lot to maintain a property.
What
And
you
then
start shortcutting.
That's what I'm saying, right? So then now the property suffers.
Yeah,
Yeah.
It starts. Maybe you're not keeping up. Maybe you're not doing landscaping as much.
Yep.
Maybe you're not hitting the repairs fast enough.
Yep.
Yeah.
Or at enough quality. You're just doing patchwork.
Are you saying that these are the types of legislative initiatives that create environments in which you have horribly unaffordable housing that's in poor condition, and high taxes, and low wages, and
You want to go down a rabbit hole?
California?
I
Yeah,
think it's-
I don't know if we have the time for this conversation.
I think you want to go down a rabbit hole. I think this is all designed on purpose so that so big corporate entity types comes and owns it, and we'll never own anything. And there's a whole. I can go down a real deep rabbit
I believe
hole.
it. I believe it.
Like
Yeah.
there's a
Tune in
saying.
next week.
Someone was saying I can't remember who it is, but the average American will own nothing, and you will be happy.
Oh, I've heard that guy, the French or German guy.
Yes.
Yeah.
Right.
Yeah,
And
what's
so,
his name?
and so look, you've got to take into account for some of that, right? So ultimately, when we say zero rent growth, Matt's right. You can't have truly zero rent growth factored in, because you're going to have natural cost increases year over year.
Right. And by the way, inflation impacts us too, right? I mean, if you're getting charged more for a gallon of milk or a pound of chicken at the store, right? I believe that at bare minimum, rents should follow inflation. And by the way, like I'll come back to this again. We are in a very, very unprecedented time between taxes, insurance, interest rates, and overall inflation. And I think over the next 12 to 18 months, you're going to start to see some of those ebb. Yeah. Now, how do we take those changes and really build them into how we go to market, right? 2 years ago, I was underwriting for 80 or 85% of the purchase value to assess property taxes.
Right.
Now, full purchase price times the mills rate all the time.
Has to be.
Right? Even if Luke, who does a great job, by the way, even if he says otherwise, after what we went through in Waco, it's purchase price times the mills rate.
Yep.
Two, for us, at least in DFW, insurance at $1,100 a door.
Which is a full 40% more than it used to be.
Exactly. And by the way, that's $100 a month per unit.
Yeah.
Right? That's crazy.
Yeah.
Especially when you're thinking about kind of the lower end of the market where your average rents are $1,200 or $1,300, right? It's crazy.
It's more than I used to pay for a 3-bedroom, 2-bath, 1,500 square foot house.
Exactly. Yeah. We just did an analysis on repairs and maintenance on 60s and 70s product that we own, $700 a door.
Yeah.
Right?
Mm-hmm. Up from 300-400.
We used to underwrite at 400-500.
Okay.
Right?
Yeah.
And we're continually looking to tweak that and keep it accurate, right? We've lowered some areas like syndicate or accounting, but those are the big three. And between that and rent growth, right, you've got to have those pegged. The other one, and this one is really kind of how you can magnify, multiply, or demultiply a deal, is the exit cap. And I was very surprised to see 0.5 point to 0.6% cap rate decompression that I've seen in a number of deals and a number of CoStar reports over the last couple of months.
Can you,
Really?
if you don't understand what that means,
Yeah.
make that in layman's terms.
Okay, so cap rate is very similar to a PE ratio, right? So when a company makes a certain amount of money and they're in an industry that trades at 20 times earnings, the fair price for that stock would be their earnings times 20%, right? Cap rates, very simply, are the amount of money you would expect to earn on a property if you were to pay cash for it, right? And cap rates vary by area, or they're very risk dependent, right? So area, asset class, vintage, the whole thing. Kind of you start to come up with a market cap rate.
The riskier, the higher.
Yes, and some people will look at a market cap as in DFW. I can tell you that's wrong, right? Yeah. There's information sources out there where you can dial into the cap rate on a zip code by zip code basis, and I suggest everybody who's listening to this do that. So if you go from a 5 cap, that means you're taking your NOI and multiplying it by 20 in order to get your asset value. Now, if you have a half a point worth of cap rate decompression, I'm just doing some quick math here because I'm only good with round numbers. If you go to a 5.5, your assets, so you'd have $1 million asset in a 5 cap, and it's worth, I'm sorry, let me take this back. So you have $100,000 NOI on a property, and that asset trades at a 5 cap, and it's worth $2 million, right? You take that same $100,000 NOI at a 5.5 cap, and it's worth 1.818.
Right.
So it's almost a $200,000 difference on a relatively small property.
Yep.
Right? Just by that half a point cap rate decompression. It's an 18.1 multiplier instead of a 20 multiplier.
So
now you go from a 5 to 6, and now you went from 20 to 16. You go from 5 to 7. Now you've gone from 20 to 14.
Right. So how do you, when we work our models, what do you forecast just to be conservative for cap rate 5 years out?
Yeah, I had been doing 10 or 15 basis points over the market cap rate.
Right.
And I still feel very comfortable with that. But I think there's an argument to be had that if we're expecting a 5-year hold, we might not need to be that conservative. Because the data that I'm seeing right now shows that cap rate decompression has almost peaked. And they're expecting cap rates to start decompressing again in the second half of 24.
Okay.
Right? So here comes the common sense stuff that Brian was talking about. Let's think about timelines. You're making an offer on a property right now. You're probably not officially under contract until late October.
Right.
You're talking 90 days to close because nobody wants to close during Christmas. So now you're at the end of January.
Yep.
Now you kick off your business plan in February. You're doing your CapEx, etc. You're almost through the first quarter of 2024 before you've done anything meaningful, right? So how much are you going to really underwrite cap rate differential 5 years out?
Yeah.
And are you ultimately, by being over conservative, are you pricing yourself out of a good deal?
Right.
Right? I think you've got to look at not just, and this is where I think some previous deals gone bad. There's a stink in the market right now about deals that are being foreclosed on and syndicators that have been hurt because deals aren't going the right way. But that was underwriting over 2 or 3 terms that were 2 or 3 years ago. And I think if you're underwriting under the right terms right now with up-to-the-date market data and looking at the yield curve and looking at cap rate curves and looking how market data, and once all this incoming supply has been absorbed, there's next to no new supply, right, being built or being even filed for right now.
Yeah,
correct.
We just
right?
posted about that.
And
on
are
our
we
website,
gonna see hyper growth in 25, 26 because all this new supply has been absorbed and there's nothing new being built?
That's a really good point.
Yeah, and I think ultimately,
And then are we going to sit back? Sorry, Nick. Are we going to sit back 3 years from now on this show and be like, "Damn it"?
Yeah.
sure,
Right? We priced ourselves out of a bunch of deals.
It's a very good point.
no, sure. I think 100%. I think what the other shoe that we've got to fill, right, is we can underwrite and really try to look for all the landmines.
Yeah.
And we could find the perfect deal, which is, the other shoe that we have to go out, and one of the conversations that we have with our team is, great, we have this. How easy is it or how tough is it going to be for us to go and raise capital? Right? Because ultimately raising capital right now is probably the hardest it's been in a long, long time.
Yeah.
Probably since, we weren't doing this during the 08 Great Recession.
Sure.
So we don't know what that was like. And I don't think there weren't as many syndicators back then that there are today.
Yeah, it wasn't as in vogue as it is now.
Yeah. And so ultimately, I think that the conversation is, which is why we do the show, is to really educate consumers and say, look, if a deal's being brought by, let's call it our company, Deep Blue.
Yeah.
Then you know that we are underwriting and looking for every pothole. We're looking for every buried body.
Yeah.
Yep.
and bringing it to our investors and saying, I know you're getting 4, 5, 6%, and it's safe.
Yep.
I understand that's safe.
Yeah, and I even think as an investor, that's as an LP, that's something to really focus on and be educated on is understanding how we're underwriting deals or how the operator that you're investing with is underwriting deals. We share our underwriting model in our deck, in our investor presentations. We give you all of our assumptions, every detail of our forecasts are all accounted for. And if you don't know how to read those, you don't really know how to ask the right questions either. So I think even as an investor, as an LP, don't just look at what the email says around the projected returns. Dig in, make sure that operator is accounting for some of the variable costs that we've talked about gone up and is making common sense decisions. It's important to understand what you're looking at.
Yeah, I think it comes down to data integrity and data justification. I sleep very well at night knowing that if one of our investors calls and says, how did you arrive at this underwriting? We have a very, very solid argument and data to support it, right? And that is absolutely critically important. I wish maybe we should do this, like invite some of our investors to our deal review calls, right? Because honestly, we get into some pretty heated conversations,
sure.
right?
That's what I love about us.
And I think that's warranted, and I think it's good, and I think it's healthy. But by the time we've beaten the crap out of a deal just to submit an LOI, and assuming we get that deal and bring it to the investors, I feel very, very good with how the deal's been underwritten.
Sure.
The other thing too, and I was just reminded of this a couple of days ago. We've now been talking about the economic downturn for a year, right? And the Fed just paused earlier this week. Maybe they do one more hike this year. Again, I have my money. I'm not a gambling man, but I would have my money on the fact that rates miraculously start to come down just in time for next year's election, which is a year away.
Wouldn't that be
right?
magical?
But for all the folks that are out there on the sidelines, let me remind you that if you took your money out of the market in 2008 and put it back in the market in 2009 or 2010, you missed the best bull market in history.
Correct.
Right? And the thing to do right now is be smart and be conservative, but also look longer term, right? There has not been a time where we've gone through a downturn like this and it's sustained for much, much longer than we've already been in it.
And we're going to have some PTSD LPs, right?
Without a doubt.
Right? They've invested. I know several people that are in 5, 6, 7 deals, and almost all of those deals that they are LPs in are not going accordingly.
If they were done in the last couple of years,
they were all done. They were all done within the last 18 to 20 months.
Yeah.
So they had money, they placed it, and when you do that, it's the emotional cycle of change in this, and psychology is like you go place this, you're scared, but at the same time you're feeling confident. You're sending your money out to go to work for you, and this is what people read about. This is what they're getting excited. They talk to their friends that now they own a piece of an apartment complex or XYZ. Yeah. Then all of a sudden they start getting the investor updates, or maybe they're not getting the updates.
Yeah, that's even worse.
They're like, what's happening to my money?
Right.
Or the investor updates are like little, it's not. It's not. They don't sugarcoat it.
Right.
Like when we send our investor updates, we don't sugarcoat.
No.
Right. And at times you need to know the good, the bad, the ugly, and understand that this is a X amount of hold time. This is 3 to 5 year play. And you might get 1 month or 1 quarter of an update that's not the greatest. Yeah. But as long as that operator is executing their game plan the way that they had designed, to know that, look, things can change quickly in 5 years. And usually, hopefully, for the better, if you have the right operating team on your side.
That's right. Exactly right.
100%.
Yep. So all you need to do, just go to Deep Blue Capital, deepbluere.com. Just sign up. Just go on. You're not committing to anything. Just sign up on the website, get our updates, see what's going on, and understand that when a opportunity falls in front of you, it may be a good time to act on it. And so just take that leap and sign up at deepbluere.com, and just know that at least here, the crew that we're running with, there's good. We should probably sell the recordings of our underwriting calls. Because it does have some fun times, and usually it's Matt.
Yeah.
He's right.
He's right.
We can start selling our KPI calls too.
Yeah, that we can definitely do.
Yeah,
We'll make like a Jerky Boys tape.
exactly.
gosh, right.
Yes,
That's
yes. So
And by the way, so for those that are listening, we're going to have a follow-up to this conversation with some other syndicators that are from our network to talk about how they're underwriting deals in this market compared to other markets.
Yep.
So stay tuned, because that's going to be a follow-up. And you don't have to hear us blow hot air for 45 minutes. You'll hear others.
underwriting round table.
Yes.
Yeah, we will have that, and it will be great. And all you got to do is just tune in. So hit that subscribe button.
Smash it.
Smash
it.
Look, we're going to let Matt have it today. Smash that subscribe button. Don't break your screen too hard. But the new iPhone 15 is coming out, so maybe you do want to smash it and get that new phone. Leave us a review. Subscribe on YouTube. And look at Matt's LinkedIn. He's posting a whole bunch of stuff on LinkedIn.
Yeah, 100%.
Yeah.
All right, boys.
Good stuff.
Good stuff.
Let's go enjoy the weekend.
Let's do it.
Yeah.
All right.
Thanks,
Thank you,
everybody.
guys.
Later.
Later. Bye.